I made a list of the best ETFs you could buy to gain exposure to China. These are pretty much the SPYs and the QQQs of China. Now, before we get into those, there's two things I want to talk to you guys about. Number one, why invest in China? And number two, what stocks to look out for? What specific stocks that you want to gain exposure to? See that some of these ETFs are selling for the same price they were selling in 2009, which is just insane. While we look at the GDP growth, we can see that America isn't even in the top 10 fastest growing GDP growths for the next 10 years. They're projected to grow at 1.4% every year, which is pretty sad. While China is expected to grow at 4%. By hitting the subscribe button, you join an exclusive club of investors who look for the best returns on their money. There's two videos you want to look out for. Number one is why the American economy is in a bad shape and a foreseeable stock market crash is bound to come. And the second video is the best Indian ETFs that you can invest in because India is growing much faster than China is. Just because the Chinese economy is going to grow, that doesn't mean all of their stocks are going to grow. We want to know what specific stocks we want to invest in. That's where you should be aware of BATX stocks. So what is BATX? BATX is pretty much the Magnificent Seven of China. Companies like Alibaba, Tencent, Xiaomi, and Baidu. Just to give you a quick overview, Baidu is an AI company. And one insane thing about Baidu is that right now, Baidu is working on self-driving, just like Tesla, but they have already incorporated that in Wuhan right now, a large city in China. You can have self-driving cars around the whole city. They're way ahead of Tesla, way ahead of America. Alibaba, you all know this. They're in e-commerce and they are also in the cloud service, just like Amazon and Google. Xiaomi is pretty much the Apple. They sell smartphones and they're a tech company. Problem with the Magnificent Seven is that the Chinese government often installs barriers for their Western counterparts. So they don't want Google, Meta to gain exposure to their market. They want Chinese companies. And China is the second most populated country in the world. And the best thing is that these companies aren't only in China. We can see that they have millions of users in global markets and more than 150 direct global investments and acquisitions. For example, Tencent bought $2 billion worth of Snap, holding 12% of the market share. An interesting investor is Michael Burry. So Michael Burry called the Big Short in 2008 financial crisis, and he is currently very bearish on the American economy, and we can see that by looking at his portfolio. 23% of his portfolio is in Alibaba, and he's already up 18%. But one specific company I really like is Baidu. He is down 9% on Baidu, and it's 11% of his portfolio, $7 million. You don't invest $7 million unless you do thorough research. He started buying the company in the $100 range, and it is currently sitting at $94, reached lows of $81. And if you look at this, it is selling for the same price as it was in 2020, in 2019. I believe it's selling for the same price it was selling in 2014, while the company has just been growing outstandingly. All right, now let's get into the ETFs, guys. So if we look at this, this is the best Chinese ETFs. So we can see that 2801 is one of the ETFs. It has an expense ratio of 0.2%, which is the same as QQQ. It holds 700 companies and has 42% of the ETF in the top 10 holdings. The biggest holding, of course, being Tencent. 14% of their whole ETF is in Tencent, and there, of course, is Alibaba PDD Holdings. If you, like myself, want exposure to tech, there's the high-tech ETFs. So high-tech ETFs like CQQQ, which I really love because 43% of their portfolio is in tech. Of course, the largest holding is Tencent. They have Baidu as well as 7%. But the bad thing is they have an expense ratio of 0.6%. That's why there is 3067. So this is another ETF with an expense ratio of only 0.25% and has 72% of its portfolio in the top 10 holdings, like Xiaomi, Tencent, JD, and Mutan. Now, if you want the lowest expense ratio, you should take a look at this ETF, 2800. This ETF has an expense ratio the same as the SPY and the VU and the S&P 500, 0.08%. Most of their ETF is in financials. 53% of their portfolio is in the top 10 holdings. So if you look at all these ETFs are pretty much 50% and above in the top 10 holdings, which I see as a good thing. SPY is only about 30%. QQQ is 50%. You want exposure to the best performing companies to get the best returns. Now, in reality, all of these ETFs are going to do very well for the following 10 years, and you can't really mess up by buying any of them. Now, if you want to know which one I'm buying, comment down below and I'll answer you. And of course, if you want to watch some other videos like the top 3 stocks overall that I love and I continuously buy, you should check out this video. Thank you guys very much for watching, and I hope I see you in the next one.